Yay, made it on time this morning. Good morning, traders. Tuesday, May the 3rd from a wet Chicago. I think the weather's going to get better next week, apparently. So rain today, dry tomorrow, rain on Thursday, but after the weekend, temperatures start to rise and it looks like it's clear. Can't wait. Had enough of this winter. Good morning. Good morning to our traders in the US. Good afternoon to our European and UK traders, and good evening to our Asian traders. Federal Reserve week this week, all focus for us, certainly in the United States, on the FOMC and their release tomorrow. So I'm expecting a relatively quiet day ahead of that. And talking to central bankers and federal committees, the Royal Bank of Australia raised rates this morning, as expected that they were going to raise rates, but they raised them by 0.25% to 0.35%. We can see it here. Now, that's a surprise, largely because the RBA Governor Lowe is a perennial dove. What does that mean? It means that he has always been more erring on the side of looser monetary policy, lower interest rates, and he turned more hawkish than we've ever seen him, and that's happened also over the past month. And today's raise was actually very unexpected. You know, the forecast of to 0.25, and actually the actual rate is now 0.35, is a lot more than the market was expected. And why is that significant? Well, that's because central bankers around the world are clearly worried about inflation. And what does that mean? That might mean for us that Bank of England on Thursday and FOMC tomorrow, are our bankers going to be more hawkish? We'll have to wait and see. But nevertheless, that's what kicked off this morning in the markets, an unexpected, more hawkish stance by Lowe, the RBA governor, the Royal Bank of Australia, and an increase beyond the expectation of 0.25 to 0.35. I think the markets are going to be quiet. You know, yesterday we entered, we had a bank holiday, so welcome back to our UK and parts of Asia that had the day off yesterday. The markets were a little bit thinner than expected. Trading was choppy. We did test the lows. There was no follow through. I think that test of the low was largely on the back of a fat finger. What's a fat finger? Well, we actually discussed this in one of our emails that we send to you, and link to the 5 biggest fat fingers in history. Essentially, a fat finger is a mistake that a trader makes when they're trading, and they input something they don't mean to, or press the wrong button, hence fat finger, and actually make a trade. Now, Citigroup said its London trading desk was responsible for a flash crash in Europe on Monday that sent shares across the continent tumbling and had a knock-on effect to the US after a decline in the Swedish stock market by 8%. And they put it down to one trader inputting something wrong. It always happens like that. You know, so, you know, when you're trading up a frenzy and you sell one instead of buying one, and you get frustrated, know that you're not alone. This trader for Citigroup managed to sink the Swedish stock market by 8%. So I have no idea what sort of loss they're sitting on at the moment, and how they're going to deal with it. I know that they are speaking with the exchange and regulators to try and figure out what's best to do here. But if they bust the trades, then they bust the trades for the counterparties. And let's say Citigroup lose 150 million, it doesn't mean the counterparties made 150 million. Some may have taken the other side of those trades and then hedged that out somewhere. So if you bust those trades, they're busting one leg of the hedge that the counterparty has taken. So you know, that now leaves them in a precarious position. So actually, it's unusual, really, for exchanges these days to bust these fat finger trades. One of the biggest ones in recent memory was Knight Capital, which was a huge New York-based algorithmic market-making group, and I can't remember what they lost. It was about sort of 10 years ago, 7 years ago, but it's something like 850 million, misfiring algorithm, and that sent the company into liquidation. But nevertheless, Citigroup can wear this. But what it did is it had a knock-on effect to other stock markets around the world, as it looked like a wave of selling was coming. And we, the S&P, we'll have a look at the charts in a minute, tested the lows, but have been rejected from the lows. So technically on a chart, everything looks bearish this morning, but I actually think we're going to hold in. We're not going to test the lows. We're in for another sort of day of consolidation, a little bit of chop just ahead of the FOMC tomorrow. Let's come on to that in a minute. Let's have a look at the data this morning. We've touched on what happened at the Royal Bank of Australia. Looking at Germany and Eurozone and UK, some data has been released already. We can see unemployment is off slightly. The unemployment rate is unchanged in Europe. Manufacturing PMI in the UK, a little bit better than expected, but we do have headwinds there. I'm going to read you an article on that. It's nothing significant, and the unemployment rate out of the Eurozone is off slightly. So, kind of a mixed bag, not much there. There is actually one other number that's not on this calendar this morning. I'm looking at the CME's calendar, and it's the EU PPI. So like an inflationary number, and that came out higher than expected. I wonder if we can see it here. The consensus was for 5%. The previous was 1.1. The actual was 5.3. So inflationary pressures building in Europe. Talking of which, Christine Lagarde is talking. Excuse me, Christine Lagarde. Have I closed out the wrong thing? She's talking this morning. So Lagarde's obviously the president of the ECB, the European Central Bank, the committee that sets the monetary policy throughout Europe, the equivalent of the FOMC here in the US. She's speaking at 9 a.m. US time. 9 a.m. Eastern time, I beg your pardon. So, it'll be interesting to see what she says, see if she turns more hawkish like the RBA did, responds to the worse than expected PPI. Let's have a look. I think I pulled up a, here we are. Eurozone PPI, producer prices in the euro area continue to skyrocket, with the details showing increases of 11.1% on the month in the energy sector, 2.8% for intermediate goods, 2.4% for non-durable consumer goods, and 0.8% for capital goods and durable consumer goods. So I think that, obviously that PPI has been driven by price of fuel. But nevertheless, the number came in higher than expected. So we can, inflationary pressures building. What's new with that story? Come on, we all know it. We're all sitting on it. We're all waiting to see how the central bankers react to it. So the FOMC starts today. The results for the FOMC will be tomorrow. And we're expecting a 0.5% hike, but we want to see what the forward guidance is. And talking of forward guidance, just jumping back quickly to the Bank of Australia, the forward guidance from Low was more hawkish than he has been too. So definitely more rising panic amongst central bankers. Not quite there yet, I don't think, but definitely more on the hawkish side than they have been recently. Going back to the calendar, there's Lagarde speaking. We have some job openings, JOLTS job openings in the US. We have the US non-farm number on Friday. So another really, really big number for us, but all focused to the FOMC at the moment. So we can leave that. But sometimes the JOLTS job openings and the ADP figures on the Wednesday before non-farm, used as indications to what, might potentially be building in the non-farm data release on Friday. Other than that, there really isn't that much out today. So I don't think the data is going to be what's driving prices today. And I think we're in for a pretty sort of subdued session. We'll have a look at the charts and go into a little bit more on that in a moment. This is the morning bid from Reuters. First Sweden, now Australia, two central banks that had said they saw no need for rate hikes until 2023 or 2024 have eaten humble pie in the space of a week. Australia on Tuesday hiked rates by 25 basis points to 0.35%, a larger hike the markets had bet on, and confirmed more to come in the months ahead. So there you go, turning hawkish as we mentioned. It has doubled inflation forecasts for this year. Just goes to show how much inflation has surprised to the upside, and with China lockdown still continuing, there may be no respite to the supply chain issues that were one of the causes of the price explosion. An RBC report has found global port congestion is worsening, with marine insurance costs still rising, and 1/5 of global container fleet is stuck in various ports. Ouch. Next up is the Federal Reserve meeting, which starts later today and will continue and concludes on Wednesday with almost certainly a 50 basis point hike and an announcement that balance sheet reduction will kick off next month. So, European equity markets opening firmer this morning, and US stock futures also high too. That was after the flash crash. So I'll talk a little bit about that when we take a look at the charts. And then these are sort of the key developments going into today. Data releases, as we touched on, not much going on there. There's a story here for our oil traders about BP. BP, it's interesting. They're up after the close in trading, and it outperformed well, despite biggest quarterly losses after writing down 24 billion to exit its Russian business. But it has a strong operational performance on the back of skyrocketing oil and gas prices. What other stories did we have here? I'll look through the headlines. UK April final manufacturing PMI. So this is the final number. That's not the preliminary number. But despite a further rise in inflationary pressure, manufacturing growth in the UK picked up a little from 5-month lows in March. That said, there were some notable headwinds, with new order growth seen slumping to a 15-month low and weaker foreign demand being observed as Russia-Ukraine conflict continues to wager on. So, it's kind of like, sort of a mixed to neutral bag of data this morning. Looking at the technical analysis reports, we can see the S&P. This is Steve's market chartist group producing this this research for his clients and providing it to our traders at trade day. We can see that technically it's pretty weak. Day trade setup, we see a downside bias through 41.03 and a quarter for 40.56, and then the key May 2021 swing support at 40.55 and maybe 4029.25. So it's kind of got a bearish slant there. My feeling a little bit is, looking at the charts, let's go and start with the E-mini as always. We tested these lows here yesterday. This is probably on the back of the fat finger in Sweden, and they were rejected. So for me, what that says is that there was no fresh, new institutional selling other than a mistake by Citigroup coming into the market. As we tested these lows, broke through, there was no follow through with paper, and they were quickly rejected. I think this was on the news here that it was a fat finger by Citigroup, and it's kind of like pulled the market sort of back up into this sort of area of support here. Now, unless something breaks on the news front, I personally think today, we're not going to break through these lows. We had the strong rejection yesterday, despite it looking very bearish, and we have quite a nice, you can see, downtrend forming here on the hourly, and we've tested that actually overnight and failed from there. But I can't see us really breaking through this level of support here, and testing the lows and then going into the lows ahead of the FOMC. Right, I think we're in for a consolidation day, very relatively quiet. We might test this. This is only an hourly downward trend. We might test it if we break, certainly up towards these sort of levels of resistance. It's going to be very, very, very difficult for the market to get up here with any sort of without any sort of real developments in news. So a little bit of chopping around, maybe a look towards the lows. I think a rejection, maybe a look towards, breaking this trend line, maybe a successful break, but up towards this area of resistance, and very unlikely to sort of get up towards these highs. Don't really see any reason why we should break Friday's highs. And again, difficult to break yesterday's lows. So I think that's kind of the story for today. If I was trading, I would sort of sit on the sidelines. Unfortunately for me, I actually do have some bearish positions on, but not actually in futures. I've got some bearish position in Bitcoin options and a bearish position in Facebook stocks, as I mentioned yesterday, but I don't think those Facebook stocks are looking too good. That share price seems good and firm at the moment. I expected it probably to sort of like sell off after its post-market rally on Thursday, and it hasn't. So, usually if a market hasn't done what I've expected it to do, I'm looking to cover my positions. The Bitcoin one I'm still pretty bearish on, but I think ahead of FOMC I've got to eat another day's time decay because I don't think the markets are going anywhere today. The Nasdaq is a very similar, obviously, to the E-mini S&P. Rejection of the lows, back up into the range. Again, sitting on a nice downtrend here. Did I just pull that from there? And putting all those lines all right. So we can see here a very nice sort of like downtrend forming, and it's kind of sort of like almost bouncing off it. I think at some point we might test it. Technically everything looks bearish, so we shouldn't really be surprised if it drifts a bit lower today. But really, without any sort of lack of any sort of big data or fundamental news coming out, people are on the sidelines waiting for the FOMC and waiting for its forward guidance. Right? And that's what drives price, institutional buyers and sellers. And I think that they're just sitting and waiting and see for the next day or two. So really be careful about trading. I'll have a quick look at oil. Oil, we can see, still remains in this range. Steve has technically oil as a little bit bullish. I think it's going to consolidate. It might test this trend line today and push up towards sort of this highs of 109. But again, we're still kind of stuck in this pattern without any sort of fundamental news to drive us. So kind of like wrapping up the morning meeting there. That's kind of short for me, but as always, I'd like to wrap up with a thought for the day. And yesterday I mentioned something about having a position is a good way to give you a feel for the market, and that I would talk about it in today's meeting. So the thought for today is, how a position can help you focus and help you get a feeling for market direction. And I'd like to share a little story with you. I remember I was trading and clearing GH financials on the live floor in the mid-90s. And a huge bond trader, US Treasury trader, came over to the UK to trade in the German government Bund pit. That was one of the biggest bond markets on the floor, or the biggest bond market on the floor at the time. And Carl Baraka was a wave of American traders that came over from the Chicago Mercantile Exchange and the Chicago Board of Trade to what they saw as a bit like the Wild West, or not as markets that aren't as mature and more opportunity. A wave of American traders came over. My wife was actually, or my future wife was, one of those. That's why I'm living in Chicago. I married an American, and she was on the Chicago Mercantile Exchange floor in the early 90s, and she came over to London to trade in London and actually to be a broker in London, Phil Paper. But Carl Breaker was one of those traders, and he was clearing GH Financial. So essentially, we were colleagues. And I remember watching him enter the German government Bund pit one day, and the first thing he did, without really even sort of settling in and watching what the market's doing and things like that, is he just bang sold 20 German government bonds, 20 bunds. And I was like, wow, that was a quick decision. And but then I noticed him do it the next day, and I noticed him do it the day after. And I said, Carl, how come you always sell 20 bonds right off the bat? And he said, well, by doing that, it helps me, one, focus my mind. If I have a position, then I'm really focused on what's going on in the market. And two, it helps me decide which way I think the market's going by, how easy was it to fill that order? So, normally what he would come in is he wouldn't just like hit the market with 20 buns, but he might work an offer and see if he got filled on the offer, or if he got partial fill, and then sort of went down and hit the bid on the balance but missed those. How easy was it to fill that order? And if it was super easy, then he's, oh wow, then the market's likely to go up. There's a lot of buying pressure in here. But if it was hard and he had to sort of fill that order across 2 or 3 prices, then that would tell him that the market was weak. And that was certainly his logic. And he would use that as an indication of, how am I going to play the next hour? How am I going to play the rest of the day, type thing. So, interesting sort of approach. Now, I'm not advocating that you guys go out and sell 20 treasury bonds just to try and figure out, or 20 E-mini S&Ps, which way the market's going. I know you can't do that, but before I sort of share what I think you could do, I'll like to tell you a little bit about my experience sitting on a trading desk. And I remember in the sort of mid 2000s, I was trading interest rate markets. The interest rate market picture was very quiet at the time. Inflation was contained. This is the early to mid 2000s. And so the markets would be really, really stable. And I was trading a lot of spreads. And what I was finding was that it was really, really, really difficult for me to concentrate because the markets were so quiet. I had my mind on other things, and I'd be distracted. And then when the market moved, I wasn't prepared for it, and it kind of would catch me, and I'd miss the opportunity to make money. A little bit of a frustrating scenario, and I really kind of lacked, because I wasn't trading actively, lacked a general sort of feel for direction and a feel for sort of bias. Is this market weak? Is it strong? Is it choppy? Is the volume high? Is it low? Kind of lacked that. And I remember actually at that time thinking back to Carl and watching him put on those 20 lots, sort of around sort of 7 or 8 years previously. And I developed a strategy that I would come in every morning and I would put one spread on, just one spread. And so the risk was incredibly low. But what, of course, it would do is, how easy was it to leg into that spread? And that would give me a feeling on direction. And then once I had that spread on, because I had a position on, I'm looking to try and get out of it or add to it if I felt like it was a good position. Bang, I'm focused on the markets, right? And that really, really helped me. What can you do? Well, until you're trading sort of larger size, then by putting on a small position just to give you some focus and give you a feel for direction, is probably not the wise thing to do. But you might be in a position whereby you can just throw one micro contract on, so you're not risking much in the way of capital. Most micros are worth around $1 a tick. But what it might do is it might give you a feel for what's going on in the market, and it might give you a new level of focus, right? Because you've got that position on, and now you're watching the market intently, trying to pick up its rhythm, trying to figure out where it's trying to go next. So that's one thing that you could do. I do it occasionally. Throw on a micro. How does it look? How does it feel? It brings in my focus into the market. and it can help me form and make better trading decisions. So there's just one thing I wanted to share with you. Tuesday's thought for the day. As we wrap up the meeting this morning, 25 minutes in, short for me, I want to wish you all a great trading day. Remember, FOMC results come out tomorrow. It's light on the data front ahead of then. Barring any breaking news headlines, we're likely in for a relatively quiet day as all focus to the Fed. Good luck and have a great trading day.